Averaging down sounds like discipline. The stock dropped, you buy more, lowering your cost basis. The financial media calls it dollar cost averaging. Long-term investors love it. For active traders, it's account suicide. Every time you average down on a losing trade, you're doubling your exposure to a chart the market just told you was wrong. The stop you carefully calculated, gone. The position size you carefully sized, doubled. Today, why averaging down works for investors and destroys traders. The structural difference between adding to a thesis and adding to a chart, and the pyramid rule pros use to add only to winners. Here's the key distinction. Dollar cost averaging works for long horizon investors buying a broad index. The thesis is markets rise over decades and your individual entry timing is irrelevant. For an active trader holding a specific setup with a specific stop, averaging down is the opposite. It doubles exposure to the exact chart that just invalidated your entry. The structural answer is to pyramid up instead, add to a position only as it moves in your favor and proves the setup. That compounds edge. Averaging down compounds mistakes. Watch this in a synthetic chart. A trader buys at 100. Stock drops to 90. They double in, telling themselves the price is better. Drops to 80. They add again, lower cost basis. 70, 60, 50. Each add felt rational at the time. The cost basis kept dropping. The position kept growing. By the time price hits 62, they've quadrupled their exposure to a chart in clear breakdown structure. A single rule, the original stop, would have capped the loss at 10%. Averaging down turned a 10% loss into a 40% account drawdown. Here's the rule. Add only to winners. If the chart proves the setup was right, price extends in your direction, and you can move the stop to break even, then you can pyramid a smaller second tranche on top. If the chart breaks your invalidation level, you exit, you do not add. The discipline runs in the opposite direction from human instinct. Instinct says cheaper is better. The chart says the cheaper price is the wrong price. Trust the chart, not the impulse. Now with the pyramid rule, buy at 100. Price extends to 108, move stop to 101. Add a smaller second tranche around 108, stop on the combined position at 105. Price extends further to 116. Trail the stop up to 110, add a third smaller tranche. By the time price hits 130, the position is fully built entirely from confirmation, not from hope. Same trader, same chart, completely different risk profile. The pyramid scales with edge, averaging down scales against it. On a real chart, the workflow is mechanical. Initial entry, one risk unit. If the chart confirms and your stop moves to break even, you can add another half unit. If the chart confirms again and your trail tightens, add a quarter unit. Each add is smaller than the last, and each add is funded by confirmation, not by drawdown. The position you ultimately hold is the position the market earned you. That's the difference between a winning trader who lasts and an averaging down trader who blows up the first time the chart genuinely breaks. So, averaging down works for long horizon index investors and destroys active traders. Adding to a losing position doubles exposure to a chart the market already invalidated. Pyramid up instead, add only to winners, only after the stop moves in your favor, in smaller and smaller increments. Edge compounds, mistakes don't. Subscribe for the full method and trade your own plan. Education, not financial advice.